So getting back to your two things, you've got the fiscal stimulus, which is putting money in people's pockets and supporting jobs and businesses. That's real economy stuff. That's actually building roads. It's building bridges, building tunnels. It's actually doing stuff which employs people. So fundamentally, that's creating wealth and creating jobs for people. That's good. The monetary stimulus, the free money and money printing, doesn't go anywhere except asset prices. That's why you get house prices up 20% in every country in the world, including Australia. It's all it does is push people on the lower income scale out of the housing market. So that's bad in every form, but everyone knows it's got to stop.
But
so
when?
In the US, this is a great debate. You've got fiscal stimulus, which can't continue because it creates debts that kids have got to pay off. So of those two, the fiscal pie and the monetary pie, probably everyone agrees that the fiscal side is doing a reasonably good job in creating real incomes and real jobs. The monetary side is pure fluff. It's just creating crypto bubbles and afterpay bubbles and what have you. So of the two, probably, and you look at the various members of the Fed over the last couple of weeks have done some talking, some out of school, some in school, to say that, look, the Fed's got to act. So we've got to reduce the monetary stimulus side. What that means in practical terms is cash rates will rise. Now,
well, don't we need to see the bond buying programs reeled back?
That's right. So what the Fed over the last month has done is, which is good. Remember there was a big inflation scare in February, March, when bond yields suddenly jumped up in Australia and around the world because everyone said, holy crap, they're going to raise rates soon. So bond yields jumped, which means bond prices fell, and bond markets around the world fell by 2 or 3%, which is a big deal for bond markets. Share prices kept going, they flattened. That's the point, the share prices flattened off after the rebound last year. So what's happened since then is, sensibly, Jay Powell at the Fed has said, look, yes, we will eventually need to raise rates, but here's a timetable. And the timetable says, before we even touch rates, we're going to have to slow down the QE asset buying. So remember back to May 2012, and again in May 2013, you had this taper tantrum.
Taper tantrum tongue twister.
And they suddenly said, oh, we're going to have to start raising rates or tapering out of QE, and that caused markets to sell off around the world in 2012, again in 2013. So every time they tried to do that, markets fell off the cliff. Now, they did eventually taper a QE buying back to zero by 2015, 16.
Then communicated and over-communicated around it very slowly.
That's right. But then they started to raise rates. So the problem with that is the Fed, throughout history, has always acted too late and therefore too heavy-handed. They've always come down too hard and too late. Why too hard? Because they've been too late. Only one exception, that was Greenspan in '94, and they don't want to do that again when he went preemptive. That's the last thing they want to do. So they know they're going to learn to try and flag their rate rises slowly and carefully. Now, given the post-1980 deregulation, small government, hands-off, globalization, low taxes, that world is gone. That disappeared in the GFC. We're now into a Keynesian world in the 1930s and 40s and 50s where governments own and run everything. So every time something goes wrong, governments will throw money at a problem to fix it. Just look at the COVID crisis last year and the lack of bad debts in banks. So the Fed is now probably going to be terrified. Jay Powell raised rates the Fed raised rates 9 times from 2015, December 2016 into 17 and into 18. And share markets, 4 rate rises in a row in 2018, share prices fell 25%. So they know that if they do that again, share prices will fall off a cliff again, and they'll have to bail out the shareholders again with free money. So they're terrified of doing that too early. So what I think they'll do is they'll wait far too long. Inflation, forget the 5%, but the real inflation, the real road going north, the real inflation will start to rise by 2 or 3 or 4%, which is real inflation. Wages will start to rise, house prices will keep rising. So the Fed will act too slow and too late. So probably as I've always said, there's going to be lots of temporary bond scare, inflation scares from time to time. We saw one in February, March this year. bond yields jumped up by about 1%, then they fell back very, very sharply this year. So bond yields have come back to, you know, a bit above 1% in Australia and the US and even Canada. So that's actually, and they're even deeper negative in Europe, and they're negative now in Japan again, even though they're trying to pop it up to zero. So I suspect that the Fed and other central banks around the world, pretty much every central bank around the world, including Australia-ish, Canada, New Zealand, UK, Europe, and the Fed have all said we need to start thinking about talking about a timetable. So the Fed had a famous meeting last month, which was the meeting where they talked about talking about raising rates. So we know they're thinking about it. The former head of the New York Bank was on last night saying we're gonna go early. We're gonna have to go early, and he's not in power. He was a former head, but he's saying we will need to start really doing something now. So share prices have been drifting up because profits have been the profit hole of last year has been filled up.